Hey guys, Frank Minetti, Branch Manager, Advisors Mortgage Group Freehold. Glad to be joining you guys here today. I want to talk about a very, very important topic. If you're considering home financing of any kind, whether that's purchasing a home or refinancing a home, it's important to get to know your credit report. Actually, you have to get really intimate with your credit report. Now, most of us know, hey, my credit score is 720 or my credit score is 740. But how many know out there, there's different models for different reasons? For example, when you go to apply for a car loan, they use a specific model. If you apply for a credit card, they use a specific different model. And when you apply for a mortgage, there's also a different model. So I can't tell you how many times I have clients that come to me and then I'll ask them, hey, what's your credit score? Well, Credit Karma, and there's nothing wrong with these systems, by the way. These platforms are great for keeping an eye on your credit. But hey, my score on Credit Karma is 740. My score on Equifax is 680. That's great, but that's not always the model that I'm gonna see when I pull your credit. So I want to give you some tips and techniques to get familiar and intimate with your credit report. You need to do that if you're planning on any type of financing. So if you want to maximize your credit score, you know, look, we live in a credit card society. I tell all my clients this, I tell family, friends this. The reality is we all need credit to some degree, but we really, and I'm talking about me and my situation with my wife, we try to use credit as convenience, not as a rule of thumb. If we can't pay cash for it, we don't buy it. Now, we do like to use specific credit cards where we can get points and things like that, where I can go away and have my hotel rooms paid for it. So that's awesome. But really, as a rule of thumb, try not to use your credit. And if you do, you want to keep your revolving balances. You may have heard that buzz term before, revolving. Revolving means not installment loan, it's talking about credit card debt. You want to try to keep your credit card debt below 30% of the available credit you have. So if you have $100,000 worth of credit available to you, you want to keep that as low as possible. You want to keep it inside that 30% mark. So you don't want to be anything more than $30,000. Now that's an extreme case, but you want to keep your revolving credit card balances at 30% or below. That will show that you have a good track record of managing your money. You know what a lot of consumers don't realize is one of the biggest factors of credit that isn't taken into consideration is your income. I'm going to give you a real world example from my own life, okay? Years and years ago, and I go back to this is probably 2007 or 2008. I had a situation where I had a number of open mortgages, right? Because I had some investment properties and I had some credit card debt. And I wound up selling a bunch of my investment properties and paying off my credit card debt by doing that. So what had happened was I had paid off, you know, maybe $1 million worth of mortgages that I had out there and some credit card debt. And the shocking thing I realized was, although I still maintained some credit card debt and I was above 30% after I got done paying what I paid off, my credit score didn't move. It actually went down. And I said, what's going on here? Well, the reality is it doesn't take into consideration your income. So I paid off this installment debt, and when I paid off the installment debt, the actual models looked at it like I was in financial trouble because I paid off things and sold things. Got to watch that, right? You got to watch what you're doing. And then credit card debt, if you're above 30%, it's going to have a little ding and a negative impact on your credit score because the credit score platforms don't know what your income is. You know, you could be a billionaire carrying 60% balances on your credit cards that mean nothing to you because you're a billionaire, and your credit score is going to be negatively impacted by that. So keep your balances below 30%. Also, if you're planning on financing, right, mortgage financing, keep your inquiries to a minimum. Every credit inquiry you put out there, okay, is going to be roughly 3 to 4 points hit in your credit score. So keep your credit inquiries to a minimum. We want to do whatever we can. Look, the best interest rate environment is predicated upon a 740 or above credit score. So that's what we want to get you to. You know, certain you want to make sure you pay all your bills on time. We don't want to see any 30-day late payments, anything beyond that. No collections, no charge-offs, right? A charge-off means your creditor wrote the debt off and considered it uncollectible. So we want to make sure that there are none of those types of things hanging around your credit report. They will have a dramatic score. Now, what I see more than anything when it comes to the collection account world are medical collections. You know, it's important that you keep on top of your insurance companies. If you go to the doctor, a lot of us have copays. Well, not all of us, right? We have copays. Make sure you're paying that copay. Don't all of a sudden get something in the mail that says, hey, you owe Dr. XYZ $50. Don't ignore it. Make sure you get on top of it. That $50 collection account that it could turn into has a huge impact on your credit score. And even if you pay that collection account off, it won't instantaneously raise your credit. It has to be over time, unless you can get the collection agency to remove that score. So I want to talk about your individual situation. If you're concerned about your credit, you know, click the link in the bio and we want to talk about it a little bit further. You know, there are some products that I have available to me with the outside agency that we have that runs our credit reports that allow me to do research into what can we do to improve your score. So we want to get your score as high as possible so when you borrow, you get the best possible rate available to you. So get intimate with your credit score. Keep those balances low, keep your payments on time, keep those inquiries at a minimum. And if you're considering buying a home, let's say you're looking right now and you're shopping, don't buy anything new. Credit reports have lag time. You know, for example, if you go and purchase a car today or furniture today, it's not going to hit your credit report till maybe 30, 60 days down the road. What does that mean? The credit report I pull, you know, to help you through your financing, I'm not going to see that debt. It's going to come up after the fact. We will know, because we do, and a lot of you people don't know this, we pull your credit report, a hard pull on your credit up front. We see your credit scores, we see your accounts, your balances, but then right before closing, we do a soft pull to make sure you haven't taken out any more debt. And if you have, that debt can tip the scales in you being approved or not approved. So if you're thinking about buying and you're actively looking, don't take on any new debt. I'm going to say that again. Don't take on any new debt. I had people that were clients of mine 2 days before closing, or 3 days, they wound up purchasing 2 brand new cars, a Mercedes, a Cadillac. We're talking $2,000 a month in payments. We saw the inquiry on the soft pull. We had to deal with it. Guess what? They couldn't finance their house. So click the link in my bio. We'll talk further about your credit report, your individual situation, and we'll put you on a path to get your credit score where it needs to be. Again, this is Frank Minetti, Advisors Mortgage Group Freehold. We look forward to helping you guys purchase and refinance your next home.